Good afternoon, traders. I'm Tom White here on Daily Trader, filling in for Kevin Hinks right here on the Schwab Network. We got a couple of big trades to talk about in some Mag 7 names that have been underperforming recently. The first one that we're going to cover here is Meta Platforms. It's the only Mag 7 that's actually positive in 2025, still only up about 0.5% as of Friday morning, but at the same time, it's outperformed, still down about 16 or 18% from their all-time highs. It was in bear market territory earlier this week, but it has come back. I think one of the key levels that we're going to focus on, and that is kind of the basis for this example trade that we're going to give you in Meta Platforms, is the 200-day simple moving average on this one, which is about $572. We have not been below the 200-day simple moving average in Meta Platforms for over 2 years, since January of 2023. So I'm going to use that as my basis for this high probability neutral to bullish type strategy here in Meta Platforms. So we're going to go out to the April 17th monthly cycle. Now, they've got earnings at the end of the month on the 30th. So I want to avoid that event while still taking advantage of some potential upside, or if the stock remains where it is, or it can even go a little bit lower, and you can still remain profitable on this type of strategy. So going out to that April 17th monthly option, a series, that's 27 days to expiration, where I'm going to sell an out-of-the-money put that's below that 200-day moving average, the 560 strike put, and then because I like to stay risk-defined, I like to know what my downside is on any position, I'll buy the 540 strike put. So a short, $20 wide, neutral to bullish put vertical, selling the 560 put, buying the 540 put. Going to collect roughly about a $5 credit. It might be a little bit lower than that, but the credit you collect is what you can make on this trade, right? We always talk about trade-offs, and I'll get into that in a minute. But if you collect that $5 credit on this $20 wide short put vertical, it takes your break even on this one down to $555. Now, what's the probability that that short 560 strike will be out of the money at expiration? It's about a 68% probability of finishing out of the money. That's what you want, a high probability of success on this type of trade. Now, if you collect that $5 credit, as I mentioned, $5 or $555 is your break even to the downside on that. So you've got a big cushion to the downside. Your risk on this trade is going to be about $1,500 if you collect $5 on this. Your potential reward is going to be that credit, as I mentioned, the $5 that you collected, so $500 per spread. But this is a type of trade-off type of position where, hey, maybe you are bullish in Meta Platforms, but the macro environment still might be bad. There's still some potential downside. Remember, none of these stocks are immune to downside in the overall market, even if you do like the shares. That's why we like to look at risk-defined strategies. So short $20 wide, neutral to bullish put vertical, collecting $5 credit, break even at $555 to the downside on this potential trade. And as I mentioned, hey, if the stock goes up, stock stays where it is, or stock goes lower but remains above 555, you're still going to be profitable on this high probability trade. All right, there's the Meta Platforms position that we looked at, that example trade. Now let's move into another name that's been underperforming over the last, I think, 8 months now since it hit all-time highs, and that's Microsoft. Hit all-time highs last summer, and it's been in a slow grind downtrend over these last 8 months or so on this one. If you take a look at it, their shares are down about 18% from those all-time highs that we saw in the summer. So we haven't seen any big, jagged moves to the downside in Microsoft. Off about 9% this year. Did it bottom recently, just a couple of weeks ago, around that 377 level? Well, if you think it has, maybe it has some upside potential. We've got another strategy that takes advantage of some upside in here. Now, they've got earnings on the 22nd. Once again, I want to avoid that earnings event, but I might want to take advantage of maybe the stock rebounds and grinds higher into that earnings event while avoiding it. So we're looking at a skewed or broken wing call butterfly in Microsoft to offset some of the costs on this bullish position here. With the stock trading right around 385, we're going to use that as a base for our positioning here. So this unbalanced butterfly, let me set it up for you. April 17th, monthly options that expire in 27 days. We're going to buy one of the 385 strike calls. We're going to sell two of the 400 strike calls, and then we're going to buy one of the 405 strike calls. So it's unbalanced. The makeup of this position is buying a bullish $15 wide call vertical, offsetting some of the cost by selling the $5 wide short call vertical on this. With this position, if you're paying roughly, we've got about 520 debit on it is where it's currently trading, with the stock at around 385. So if you pay that 520 debit, that's going to be your risk. $520 per spread on this one. Now, what does that do? Where does that take my break even to? Well, the initial buy is the 385 strike call. So you add that debit that you paid, 520, and that's going to be your break even. So it's going to be $390.20 over the next 27 days. So anything above that, because we made it broken wing or unbalanced, is going to be profitability on this one. So that break even at $390.20. Anything above there is going to be profitability. That's only about 1.3% above the current share price if the stock's trading about 385. So you don't need a massive move to the upside. Now, why did we make it unbalanced on this one? Well, if you think the stock's going to grind higher into earnings, this is one way or one strategy that you can use to take advantage of that. I mentioned that break even on it. Now, the apex of profitability, if you look at a risk profile, is going to be at or near that 400 strike. That's where you're going to make your most profitability on this particular trade, which is nearly $1,000 if it pins that 400 level. But even if the stock continues to move higher, goes above the 405 level, you're still going to have nearly a double in profitability. Just some of that profitability comes down a little bit. But those are the trade-offs by doing an unbalanced call butterfly, is that, yeah, you're trying to offset some of that initial debit when you initiate the trade, but at the same time, it takes away some of the profitability if it continues to move past that 400 strike call where you sold two options on that. You've got 27 days in it. Break even just above 390, so just over 1% to that break even. So if you think that Microsoft's going to rebound, this is one way that you can take advantage of it while avoiding that earnings event, which takes place on the 22nd. So another good look at a different type of strategy that's a little bit more aggressively bullish than the short put vertical that we looked at in Meta Platforms. So if you think Microsoft's going to grind higher, look at the unbalanced call butterfly as an opportunity or an option if you think it's going to grind higher. Well, that's going to wrap up Daily Trader here. I'm Tom White, filling in for Kevin Hinks right here on the Schwab Network. Have a great day.